Welcome back, everyone. We have another keynote presentation from Russo. He's one of my favourite speakers on the conference circuit. And Sean has a position, he's a strategist on gold, so it doesn't matter what the gold price does, Sean will still have a job. And I was just talking to Sean about, he was supposed to become a client of mine many years ago, and he said, I've got an aversion to paperwork, and we've named that disease adminophobia. So anyway, Sean, enjoy and get those forms back to me. Thank you.
Hi, good afternoon. Thanks for taking the time to come listen. Thanks to Kerry for the invitation. I did speak a few years ago at one of these conferences in about 2011, 2012, and I talked about the fact the price might go down, and I didn't get invited back for a few years. The price did in fact go down, and the speaking time's 30 minutes. If you put that 15 on the clock, you're going to scare the crap out of me in about 15 minutes' time. Thanks. Oh, it's a luxury to get 30, so I'm making the most of it. But look, so I'm very realistic. My Twitter handle is @thegoldbeast, because one day I was at one of these gold conferences and I said, look, I'm not a gold bull, I'm not a gold bear, I'm not a gold bug, I'm a gold beast. I've spent now 38 years in and around the gold market making a living, as Tony said, whether it goes up or whether it goes down. So I prefer it when it's going up, but you know, we're pretty realistic and markets change, and that's what I want to talk about a little bit today. I'm not going to try and convince you about the merits of gold. I would hope you understand many of the merits of gold. You're at a gold conference. What I would like to do is share with you some observations and some learnings that I've picked up over the last 38 years of gold market involvement, where I worked in Sydney, Perth, Singapore and London for House of Rothschild for the first 20 years of my career, and the last 18 as one of the principals and the founders of Noah's Rule, where we set about to try and help mining companies think differently about how they finance, how they interact with banks and the markets, and how they sell their metal and those type of things. And many of the things I picked up along the way were from what I would have described as old-timers, because there weren't many young people in the gold market when I started in 1984. Today, I would be older than some of those old-timers when they passed on that wisdom. Looking in the audience, I still feel quite young. It's one of the good things about coming to these conferences. Gold is truly international. Nowhere in the world that isn't mined or desired or both. Headley talked about that before. Poke anywhere in the map you're going to find it. And if they don't mine it, they probably got a stronger view on it, right? Well, the news in Australia, for reasons, you know, I do understand a bit, but it just surprises me, still quote the US dollar gold price. In many countries, it's really the local currency gold price that's more important, as it should be, because that's what you buy and sell in. Right now in Turkey, people don't really care about what the US dollar gold price is. It's what the price is in Turkish lira, and the fact they're trying to avoid the collapse of the Turkish lira, or yen per gold. And I learned this as I travelled around the world, the gold market. You go up to Japan, people, you talk about something, they go, well, 1,800 yen per gram, mate. Now, this was way back in the day, my first trip to Japan. A guy said, my granddad said, always buy gold if it's under 1,800 yen per gram. His granddad wouldn't be alive today, but he'd be happy if his grandson did, because it's 8,000 yen per gram today, as the yen makes 24-year lows. So, as we do in Australia, you've got to pay attention in your local currency. You buy and sell gold from the people here selling their wares and their supervising vaults and the like. At the end of the day, unless you're one of the few with an offshore account, you're buying in A dollars and you're selling in A dollars. And so you do have to pay respect to that. The US dollar price as well is obviously very important, because that's where all of those different attitudes from all those markets come together. So I'm going to give you a series of adages today that kind of, I think, serve me well in my approach and the approach we have with our clients. And the first one comes from an old guy called Richard Russell. He was an old-timer. He's dead now. He wrote a wonderful newsletter called the Dow Theory Letter. And he wrote many years ago, it's not a bull market unless it's a bull market in all currencies. And so this is the global gold chart that we kind of look at, and we have a scoring system that I'll talk about a little bit more in a minute, but basically those 10 different currencies, gold price on the side, if they have a positive trend, they have a positive score, negative trend, they have a negative score. You can see there when it's green right up to the top of the line, all 10 of those currencies have a positive trend. Now you can see quite clearly there, and we'll zoom in more to the more recent period, that clearly from 2001, as we flipped over there, gold was a bull market. Now, I'm a bear market baby. I started in the gold market in 1984. By the time I got to 2001, I was sell the rip. I was a sell the rip player in the same way that all the equity people are going to get totally buried in the next little while because they're all buy the dip for as long as they can remember. So I was sell the rip guy, but I told my business partner about this adage, and he was the one back here when it started to turn around. He said, Sean, you're the one that kept on telling me when it's a bull market in all currencies, it's going to be a bull market. And he was right. And we enjoyed the benefits of a wonderful bull market there. We also saw where those changes are. So I think that's the first adage, and we certainly currently tick that box. 10 out of 10. Okay, so looking at currency wars ongoing, it doesn't feel like that's going to change in a hurry. Adage number 2, and the title of this presentation is It's Nobody Else's Liability. Now, that was something I didn't appreciate when I first heard it. Bob Guy, the chairman of the London gold market, said that to me in the 1980s, and I looked at the chart and it was going down. I go, yeah, it's a bear market. I probably muttered something, even though he was the chairman of the London market, probably under my breath, something of the 1980s equivalent of, okay, boomer. But gold is no one else's liability, and I found myself the other day at the ripe old age of 59 talking to a guy who's about the age I would have been back then going, don't you think you've got to understand, William, is gold is nobody else's liability. I thought, well, maybe it's an age thing, I don't know. But, you know, what does that mean? Money in the bank is your asset on your balance sheet, but it's the bank's liability, all right? And cash is your asset and the government's liability, but it can be cancelled, as Vladimir Putin just discovered. If central banks around the world aren't dusting off gold in our possession, not at the Bank of England or the New York Fed, gold in our possession is nobody else's liability, I would be highly surprised. Now, physical copper and barrels of oil are also no one else's liability. All right, and I suspect that they will also, countries around the world will start taking larger strategic reserves of all those other things as we get into a commodities bull market, rather than just holding US dollar and euro as well. But gold is very different, and you know, I'm sure you heard the numbers again, but it's worth remembering 1 cubic metre of gold is $1.14 billion worth. 19.3 tonnes of gold in a cubic metre if we had it here. $1.14 billion of gold, 617,000 ounces. If you want to try and store or hoard copper, that'd be a 13-metre cube and you'd have 120,000 tonnes of the stuff. It's a bit hard to get rid of. 9.5 million barrels of oil is the same dollar value. That's 1.5 million cubic metres. So you want to move money around the world, you want to pay your bills for stuff you're not supposed to be buying, putting a cubic metre of gold on a plane and sending it from India to Russia is not a bad way to go. Central banks are going back to trading in gold. And for individuals, I did have the stats of what a gold, 1 ounce is about the size of a 20-cent coin. Back when I used to be in the refining business, we had to make the gold bars up in Papua New Guinea very smooth because they were internally smuggled from Singapore into countries like India. And I heard a story about a couple where the boyfriend had been shot by the girlfriend in India. They went into the hospital and they x-rayed him, try and find where the bullet was. And there's this great big shadow in the guy's bowel. And I said, what's that? And I said, oh, he didn't steal them off me. And she'd shot him because he thought that he had pooed out the 8 tail bars that he'd put up his rectum when they smuggled in the country and that he was trying to cheat on her. In fact, no, even the best curry had not cleared him out. And he'd put too many bars in there and it was stuck. Now, you laugh, but that's the way gold moves across the borders. I mean, it's not a cubic metre at a time like that, but unless maybe you've got an elephant. But anyway, I digress and I'm going to run out of time. So we again have increased recognition of gold's dual role as money issued by nobody and not expanding by much. I'm not going to go into all the things about, you know, how much gold increases every year, but you know it's a very small amount of the gold that's actually there. So, you know, money is expanding like this and gold is just still there, right? So it's nobody else's liability and we know that it's going up in all currencies. If you start talking about gold price in a forum like this, in various corners of the world, you might hear inflation, real rates, the US dollar, we've heard some of that today. And other corners, it might be crop yields, monsoon rains, or tourist numbers in a place like Thailand driving interest in gold, buying or selling. And yes and no to all of them at different times, so they all drive it. But harking back to adage number 2, over the last 4 decades, I've come to the position that we should think of gold as the opposite of money. So it is money, but it's also the opposite of money. And it's somebody else's, you know, so money is somebody else's liability. And I'm conscious this is a conference of gold companies and all companies, but you know, generally, as a general concept, gold is also the opposite of equities. Because yes, you own a fraction of a company when you buy a share in a company, but short of a liquidation, and generally, let's face it, if it's a liquidation, you're getting nothing back, or a takeover, you're never really going to get paid for your share of that company. It's a liability of a group of people who are trying to do the right thing. So, you know, gold is very, very different in that sense. And I think of gold as ownership. I think the ownership of gold is like the opposite of trust. So women, I think, would be better at investing in gold than men because they've learned not to trust. But sometimes I think that I have always realised that really became aware of this when Grant Williams, the things that make you go, started talking about this, and it really hit home to me. That, gold is the opposite of trust in banks. It's the opposite of trust in central banks, who are becoming increasingly political. It's the opposite of trust in politicians, and we've seen really the protest vote really recently in Australia about that. It's also this might be a little bit controversial, it's also the opposite of trust in ESG. Since central banks decided it was part of their mandate, I'm very anti-ESG in the way that it's promoted and the way that it's discussed in the world. And we all know that we want a brighter future. I want a cleaner future for my grandkids. There's nothing, but I don't want us running out of the energy to actually get to that new future. And the central bankers have obviously blown up the world. Certainly this week it feels like we're on the verge of that. But they don't have an answer for interest rates, so they've just moved on to the environment. Heaven help us if they can't sort out interest rates, what hope are they going to sorting out the environment? So think of gold as where you would put your hard-earned money when the other options make you feel uncomfortable. How comfortable are you feeling right now about some of your investments? Huh? So how much gold to own? And that takes us to adage number 3, the Swiss bankers' portfolio. The Swiss bankers used to say, own 5 to 10% of your net worth in gold and then go to bed every night praying you never make any money out of it. Because when you're making lots of money out of gold, you're probably losing money on everything else. But that's not to say they're negative on gold, because it always holds its value. And Ronnie Stoffel, I've had the great pleasure of meeting, and if you haven't read this year's In Gold We Trust report, I'm about page 135 on Sunday out of 320 or something it is this year. Post-war Germany, that is the price of beer, a massive beer of Stein at the Oktoberfest from 1950 to today. Think of all the things that's happened in Germany over that time. You can buy more beer at the moment, gold, than the average, right? Now, back in 1980, you would have had a field day if you took your gold along to there. But again, that's an interesting point to remember, because back in 1980, maybe you should have gone long, should have short gold, long beer. But also back in 1980, interest rates were very high. You remember, what were people thinking when they wouldn't sell their gold in 1980 at 850 when they could put it on deposit and earn 15% a year? Do the maths a little bit later, but just think in 1980, if you'd sold your gold for 800 and put a 10-year bond at 15%, what the gold price needed to be 10 years later, I can tell you the gold price was down. The people who bought bonds were a lot higher. So you're going to hold gold until the environment changes. At the moment, we're about neutral on a thing of beer. So, but that's the minimum, okay? So the Swiss bankers' portfolio, that's the minimum. 5 to 10% of your net worth in gold. Hope that you leave that to your grandchildren, because you never have to flee a border and that's the only stuff you're taking, or that the world doesn't go to hell in a handbasket. So the big question for everybody in this room, obviously for all of us, is when to own more. And I'm going to tell you that's easy. You own more when it's outperforming. When it's outperforming cash and currency and savings, you own more gold. When it's outperforming other investment classes, you own more gold. Now, obviously, easier said than done, I hear you say, but there are a few, again, simple adages I think you can do. And one of the first ones I would say is trust your fellow man. Trust in the wisdom of the crowd, not the noisy ones who talk a lot in the media, but the wise ones. Look at what the wise ones are doing. Follow the flow of money. Okay, that's the biggest thing in financial markets you can ever do, is to follow the flow of money. And when money is flowing out of gold, don't fight it. I mean, this is when I stood up at this conference in 2013. People were angry. People said they'd been ripped off. So money's just flowing out of gold, and it's not about being negative on gold. It's just they found better things to do with their money. So they're selling the gold to buy money, and we'll talk on that a bit more in the meantime. Australians should understand that. The first thing you get taught when you go to the beach is don't swim against the rip. You'll exhaust yourself and you'll drown long before the rip wears out, right? It's exactly the same in financial markets. So I've found one of the easiest ways to do this is to use simple moving average. And a lot of people poo-hoo this in technical analysis, but at the end of the day, a good measure of trend in my experience in all markets is the 200-day moving average. And if you want to take a really long-term view, the 200-week moving average. You also want to take a very good look at ratios of relative value of things, and we'll look at some of those in a little while, paying attention to long-term trends, which are really important. And then we've helped ourselves by developing our in-house scoring system, which I'll talk a little about in a minute, but it's a proprietary system we use to really try and measure trend, but as well as just measuring trend, to try and understand when the market's getting out over its skis a bit, for the skiers in the room, understand, but they're getting a little bit carried away, getting a bit excited with itself, how to just to find out when the market's gone a little bit far, when the hedge funds are going to start to turn around, start to short sell things. We try and do that. This is really when the market's going from manic depression to, unbelievable optimism. I mean, they say that, the moving average, if you like, someone will say, well, that's fair value. Well, fair value is a line that experts draw afterwards between overvaluation and undervaluation. And we are not even to fair value yet in the US equity markets. We are still in overvaluation territory. So that in itself could get interesting. So when I first learned about the 200-day moving average back in the 1980s, we had to bloody draw the charts by hand and calculate these things manually. We didn't even have computers on the desk. So you didn't have multiple moving averages like you see all these people on Twitter now with their things. You just stuck to one because calculating one was hard enough. And when I used to come into the market in the morning, I was a gold trader, there used to be Tudor Joneses in the market. And that used to strike fear into the hearts of traders and market makers alike. Paul Tudor Jones has gone on to become an absolute hedge fund legend. It was only decades later that I heard, and this is adage number 4, never be long of something below its 200-day moving average, never be short of something that's above its 200-day moving average. Paul Tudor Jones starts Everest Finance. He teaches finance at one of the colleges in America as part of a MBA, because he says you've all wasted your money because you paid your 70 grand and that's all you need to know. Never be short something that's above a 200-day moving average, never be long of anything that's below it. So let's have a look at that. Now, this is a very long-term gold chart going back to 1976. The green line is the 200-day moving average. The red line is the 200-week moving average. And the background is basically painting whether our weekly score, the Noah's Rule weekly score, is positive or negative. And we developed this weekly score really when we started to talk to gold mining clients about hedging and about risk management to say if the background is green, you want to be very careful about what you do and how you do it. The market's going your way. You can be relaxed. When the background is red, you cannot afford to be relaxed. The market is against you. And it was really this thing of trying to bring some sense into it, other than just what all the people who were selling hedging products were trying to get them to do to make money for their employer, which is who we had been for the previous 20 years. So poachers turned gamekeeper, if you like. Now you can see when I joined the gold market back in 1984 here, the 200-day moving average, it's actually quite incredible. I mean, the entire run-up in the 70s, it kept you in for most of that. Obviously, you had to do your own to get out at 800, but 600 it crossed back down. The entire bear market, that average was above it. And then again, in the fall that I was exposed and where I joined in 1984, the 200-day average capped it. And when we crossed back through the 200-day moving average, it went up. It was great. The only time it was actually a bit messy, and all of this was around the time, of the Gulf War. Got chopped around a fair bit there. But overall, it's been a very, very good guide. And the 200-week moving average has been a very good guide if you want to kind of buy stuff and invest in a very long-term thing to put stuff away for your grandchildren. That kind of time frame, I think it's fantastic. But you can see, it's been very good. Now, interesting, there's the $A with the same treatment. Even though it's a cross rate, it's still been pretty good. The $A gold price does tend to go down below the 200-day moving average a lot more than US dollar gold price. Sorry, just going to go back for a second. One thing I want to point out is you look at that entire bull run, the great bull market of 2002 to 2012, the GFC was the only time that gold actually spent any time below the 200-day moving average. And what I would say, because I'm saying it never be long of something that's below the 200-day moving average, but every time it stuck its nose below the 200-day moving average from 2000 to 2012, and everyone felt sick and everyone was telling you this is the end, it was the time to buy. And that's where we are right now. We just dropped through the 200-day moving average today. So, I'm not saying the minute that it goes below, we try and take a longer-term view as investors, but generally you've got to try and have the wind at your back, if you were. Now, interestingly, that's the $A gold price. What I think is particularly interesting there is you see the very long-term it trades sideways. A lot of gold producers like to tell me they don't need to hedge because they've got the natural hedge of the $A, but in many cases what it actually does is really dampen. So one of the things you, as an Australian, you'll go and buy gold and Aussie dollars and the gold price is going up in US dollars and you're not making any money because you've sold Aussie dollars. You're short the Aussie and you're long gold. And for a lot part of the 2000s, in the early part of the 2000s, the gold price went sideways for a very long time because the $A was going up as fast, if not faster, than the gold price. Quite frustrating, but then overall it took off. Now, before you want to cut your wrists and say, I want to move to another country so I can trade another currency, that is now laying the US dollar gold score over the $A gold chart. All right, so what this is really telling you, so these two things are not related, but other than obviously the US dollar gold price is part of the Australian dollar gold price, but what this is telling you is the $A gold price needs permission from the US dollar gold price to go up in a meaningful way, all right? Where there's that cultural cringe we've got. Now, it is also a good hedge against the Aussie going lower. Clearly, when Aussie goes low, you go. And so I don't have a treatment of it here today, but we often show our clients when you've got a red background on US dollar gold, sorry, a green background on US dollar gold, it's going up, and you've got a red background on the A dollar, it's going down like we have at the moment. We call that purple patch. And amazing things happen in purple patch, and we're in a purple patch at the moment. So we may see $8 gold prices in the near term that aren't bettered again for quite a long time, even if US dollar gold prices go up. I think there's a reasonable chance that we could have a period a bit like this, that we're up in here, that we trade sideways for quite some time, because when this commodity bull market that I believe is about to take place really starts to kick in, we see the other side of this, $8 and gold both going up. For the moment, you're actually getting a double benefit of buying gold if you're in Australian dollars. You're getting a hedge against the falling Aussie dollar, and you're getting the benefit of what has been generally a rising US dollar price. So that scoring has 6 different factors that we put in, and each of them can go from 1 to -1. So again, without going into great detail, when you look at the bottom there, you can see that line down the bottom is actually the score traversing up to 6 and down. And obviously we're trying to look to getting over your skis when it's at +6, and you're wanting to try to fill your boots generally when it's -6, and that was certainly very true in 2014. Of course, you have to break the rule, never buy anything below the 200-day moving average from that, but all rules are made to be broken. You just have to know when to break them. So that's that. Adage number 5, and this is probably, I think, one of the most important for right now. Adage number 5 is gold does best when it's outperforming general equities. The Dow Gold ratio, which actually looks at the ratio of an ounce of gold to shares in the Dow Jones, that's that line there. Back in 1900, 3 ounces could buy you, at the end of 1900, 3 ounces of gold to buy you one of each share in the Dow Jones average. 1929, before the crash, you would take in you 15 ounces of gold at the top of before the crash in 29 to buy the same shares. After the crash, you could have bought those same shares for only 3 ounces again. These are yearly closes. It was more volatile than that. Now, when Pierre Lassonde strode into Australia and became a bit of a household name in the gold mining business in the late 90s, when he said, get over yourselves and stop selling all your gold and hedging, and gold is cheap, don't you know, that ratio had rallied to 30-1. That ratio was up around here somewhere. The problem was that Pierre said that, but then it went to 40-1. So everyone said, what the heck does he know? But of course, he was right. He was just early. But lots of smart people are right early, and sometimes it's hard to confuse the difference between right early and being wrong, depending on how big your bank balance is. But Pierre hasn't suffered too badly. But I learned about this from Richard Russo, the guy I talked about before, but Pierre really put it on the front page in Australia. Why does it do well? Why is this an important thing? And when I say why does it do well, you know, people in this room know where the gold price was in the late 70s to the 1980s, right? A falling ratio is good for the gold price. So 70s to 80s bull market, 2000 to 2012 bull market for gold, right? This ratio clearly showed it. And those green and red lines we'll come back to because they're important. I'll explain those to you in a minute. But it just is that this is the opposite. Gold is the opposite of equities, and a lot of money, when it wants to own equities, we should all want to own equities. We should all believe in the future of the world. We should all have trust. Most times we would want to have trust, and we want to buy companies and be involved in real things, building real things that pay dividends and employ people. Gold bars don't do any of those things, right? So you want to get out of your gold bars and into those things. But when those things get overdone, or governments get too far involved, or central bankers get out over their skis, you want that protection for gold. And clearly, by this ratio, you can see this is where money goes. Now, I hadn't understood exactly the extent of this until I heard a wonderful podcast where a fund manager was interviewed, and he was asked about gold, and he said, I hate gold. We hate gold. It doesn't pay a yield. You can't value it. You can't get discounted cash flow. Now, I hate it. But he said, in around here, when it started to seriously outperform equities, after the GFC, we just had to own it. We just had to own it as much as we hate it. We had to sell equities and buy gold because gold was doing better than equities, and we don't know why, but the wisdom of the crowd says that's what we should be doing. Now, the funny thing is, and just before that conference in 2013 where the gold market collapsed, if we zoom in on that same ratio, the green background came early, then we went through the 200-week moving average. In 2012, before the gold price collapsed in 2013, that fund manager had gone to his investment committee and said, gold is outperforming equities. Can we please sell all the gold that we have? And he said it was irrational. We were so excited to sell that gold. We couldn't wait to get rid of it. We'd hated holding on to it for the entire time we've had it because we don't understand it, you can't value it. But you know what? In that period of time, it's one of the best investments we've ever had. And he still hated it. But people who hate gold are buying gold right now. We are below there, we have a red background, we are sitting here, and last night we dropped to 17. Now that ratio falling doesn't mean the gold price will go up. That ratio falling means that gold will fall less than equity. So that's still a good thing if you're invested. And otherwise, if you're sitting in cash, well, then you're not doing well because gold is certainly, in most cases, outperforming cash in the long run. But this ratio is important. So red background. Now, the interesting thing is, remember those green lines where I had those green lines and red lines before again, and remember these turning points here and here, because we're going to revisit those in a minute, assuming Tony doesn't drag me off with the hook. But I'm not doing too badly. So what I want to show you then very quickly is this chart now is just the gold chart, and anytime it's red, anytime it's red, the US dollar has a positive trend. It has a green background in Noah's Rule score, and the Dow gold, that chart has a green background, and we know that's bad for gold, right? So the green back. So when both of those things are happening, the background is red. Gold has just simply not done well when it's not outperforming the US dollar and it's not outperforming equities. Now, a lot of grey hair in this room could have been saved, and there'd probably be more hair in this room if we had only invested in gold when the line was blue. You'll also see the 200-week moving average sort of features quite well there in the long-term trends. I don't have the 200-day on there, but you can see now at the moment we are blue. At the moment we are blue, and the likelihood of the Dow gold turning back is not there, but the US dollar is very strong. So I wrote in our client report this morning that we think we're kind of stuck between the strength of the dollar and being buoyed by the fact that we're outperforming equities. I think the outperforming equities will win out overall because of just the volume of people in the world that would be seeking cover from gold for a lack of trust, whether you're in Turkey or Japan or wherever else is going on. So that's that. So adage number 6, gold miners give you leverage to gold. The simple answer to this is yes. The unpleasant part is that the leverage to falling gold prices is often much worse than the leverage to rising prices, and never more so than if you are invested in a gold mining company that has debt and did not take out hedging alongside that debt. Gold mining companies that totally undid themselves in 2013 to 15, and in fact the reason the whole gold mining sector performed so poorly was they had to keep selling shares to repay debt, because they couldn't do it by selling gold. So there is leverage in gold, but you've obviously got to search, right? You've got to search for the right companies, because there are companies out there that are outperforming the gold price, and that's what you want. You want to look at a ratio of how many ounces of gold, like if you buy a share, you think how many ounces of gold you could have bought when you buy that gold share, and you keep measuring against the gold price. If you could buy more gold with the share price now than you could have at the beginning, that's an investment worth holding. But when that investment starts to be worth less than gold, given that's what you're buying for, unless you think they're about to drill and find the mother lode, that's what you need to be thinking about, okay? So FTSE, I'm going to start talking quickly now if you didn't think I was before, because I've got 2 minutes and 30 seconds left. But FTSE Gold Miners Index up the top line, that's the gold shares. Green is good, red is bad. Gold down the bottom, green is good, red is bad. Falling ratio is underperformance, so red is bad. Just absorb that, and look where red is bad came in by comparison to there. So for this period of time, we thought we were doing well on gold shares, but they weren't even doing as well as the gold price. All right, so the amount of gold you could buy with those gold shares was falling. That's because they were, people who'd done really stupid hedging back in the 90s were issuing a whole lot of shares to buy that back, or they were taking on a whole lot of debt. If we bring that a little bit closer to home, Aussie dollar gold and Newcrest, one of my favourite whipping boys in the Australian gold space, rising share count is not good, okay? So here we've flipped it over now. So a rising share count, a green background, is not good for these guys. Back in April of 1984, you had 1 ounce of gold your granddad gave you, and you said, I'm going to buy Newcrest, I'm going to get leverage to the gold price. You could have bought 100 shares. You would have needed 350 shares in 1998 at their nadir when they stuffed everything up to buy that 1 ounce back before your grandfather found out what you'd done. If you'd hold them to today, they're still worth about 100. So they've matched the gold price over that period of time, and in their defence I will say they have paid dividends, but the journey on which they have taken you is not there. But the canny investor, clearly, if you think management, the asset doesn't know who owns it, this is a very important thing. If the asset doesn't know who owns it, thanks Tony, that's right. Then the asset doesn't know who owns it, then these times here, when you can buy a lot of shares for an ounce of gold and you know how many ounces they've got in the ground and management's stuffed up or they've refinancing or something, these are the times where clearly opportunistic people want to get involved. And if you just look quickly at Newmont, for example, rising share is not good. Newmont has been doing much better, right? Now, I've compared Newmont to the US dollar gold price because they're a US share and Aussie to the old, because that's where Newcrest is traded. But clearly they got their shit together long before Newcrest did in terms of what's been happening. So that's a gold share you can buy because it's clearly outperforming gold, and that's what you want. Tony, the last adage, just if you let me finish very quickly, is that history never repeats, but it rhymes. And I think that's very much where the case we are now. And I just want to show you this chart, which is a little bit outdated, but this is a long-term chart of where commodities are generally versus the world. We were in the last couple of years lower than the lowest point down here. So this is a ratio of commodities to general equities. And if you think about that and just leave you with that the ratio is currently down the bottom in the green. And you remember though where those green lines were on that Dow Gold chart? They were all at the top. We are down here on this side, and commodities have done well in crises up there. And what I can't believe as I sit here right now in the world is that we are at the luxury end of the scale here in terms of crisis at the other side. And in my 59 years, I've never felt like the world's more in crisis than it is right now. So there is a potential for us to move very much this way, and that is equities off and commodities up. So I do believe that the wind is at our back in just about all those things that we've looked at today. Thanks very much. Thanks.